How's that? There we go. We've got audio now. We get a little bit of feedback. You guys hearing okay? Okay, perfect. Sorry about that. So just to bring everyone back up to date, this is next week today. Just on the COVID, as mentioned, that no one heard, that the Pfizer vaccine is being looked at for Canada to approve to ages 5 to 11. In Britain, the UK, they're looking at reimposing some social restrictions and speed up that booster program. And of course, here in Canada, the booster program has been expanded more and more as as different provinces like Ontario and Quebec have opened it up, and now BC starting with the care homes, but will probably quickly expand out as they're seeing some of the effectiveness of the vaccine kind of tapering over time, and those who got it first are obviously coming up to that period. And of course, the WHO is taking a look at a panel to determine the origins of COVID-19. But, we've had several different committees take a look at this, different finger pointing. A lot of the experts out there are pretty skeptical of where we're going to find a true source of the vaccine. So let's take a look at what's going on in the economy. We're looking at the U.S. housing starts for September, and we're also going into earnings seasons with J&J and Procter & Gamble coming up. Stock futures for the last couple of days have been ticking up a little bit. Just on the earnings results, we've seen some pretty good numbers out there. 81% of the S&P 500 companies that have reported so far have beat earnings per share expectations. So we're still seeing strong earnings. Still keeping in mind, though, that the costs have been rising. Revenues are up, earnings are up, but they're still seeing some cost overruns as they've had to adapt to new way of doing business. But also remember that supply chain is causing raw material costs or even product shipping cost increases as they try to get product around the world through all this. The U.S. refiners are still moving along in the energy sector, set to have higher earnings than expected due to fuel demand continuing. We've talked about this quite a bit. This is going to continue. Basically, just to recap quickly, we went into the shutdown. Demand, dropped off the map. Oil went to minus $34 a barrel. So producers turned off the taps, if you want to look at it that perspective, when it comes to fuel, to limit supply because there was no demand out there. As demand has surged back, though, those taps haven't all been turned on, and a lot of them, they're leaving them off because a lot of companies have made investments or shifts of renewable energy that isn't online yet. So as we're going through this transition, we're likely to see a continued strong energy market. Hedge funds, looking to post some big gains as they've made some big bets into those commodities. We'll continue to see that move along. Canada's tax the rich plan is leaving a big debt risk untouched. So, we've done a lot of spending here in Canada, and they're looking to pay back that debt by imposing higher taxes on Canadians to fund some of these campaign promises that they have out there. But is it going to be enough? And, the rich, as we've seen year over year, corporations, they find loopholes. And will the Canadian government be able to collect as much taxes as they're hoping to cover some of these costs off? The chip shortage out there is still continuing. Hurricane Ida is weighing on the U.S. factory output, and demand remains strong. So, we've talked about the chip shortage quite a bit. The shortage is across the board. Pretty much anything that you want to go buy out there. I've mentioned before, if you want to do your holiday shopping, start it sooner than later because there are going to be limited supplies. Pretty much everything that you want to get out there. Even seeing kids' costumes for Halloween. Basically telling parents, get out there now and get them because there's not going to be any of those last minute ones left. But the focus is on chips, and the reason why we're seeing this surge on chips, and I've talked about it a little bit when I've talked about cars, relating them to the Apple iPhone. when the first Apple iPhone came out, it was revolutionary. I mean, the latest iPhone 13, I don't know that it's a lot of difference, unless you're a big camera buff, but generally they haven't changed too much. But that first one came out, was revolutionary. It gave you so much power, so much capability in your hands. Yes, they've gotten faster and more memory and all these other features that they brought in, but it was that first transition. Well, we're seeing that, I've mentioned cars. New cars today are basically the new iPhones. They do everything. We've talked about how they self-diagnose, they download their own softwares and fix themselves on the fly. And more of these cars, and that's not even touching on the self-drive push that some of these manufacturers are trying to get out there. But it's true of almost every product, right? Everything we have today, it runs off a chip. So when you think about the chip supply shortage, it impacts so many different things that we do, from your appliances, obviously anything electronic, your computers, even people talk about, Bitcoin mining, all these different areas. It's all driven by chips, the kids' computer games, the handhelds, all these things. So that's why the focus is on the chip shortage, because it's affecting so much of that supply chain. We've all seen software firm Informatica out there looking at getting a $9 billion stock valuation. So this continues the IPO growth that we've seen since the later half of 2020, as they push, kind of push the boundaries. This is a company that went private, about 6 years ago, and now coming back public again to take advantage of the IPO frenzy that's out there. New York is actually, speaking of cryptocurrencies, New York directs 2 cryptocurrency lending platforms to cease activities. We're going to see more and more of this, not picking on cryptocurrencies. I know I've done videos about it before, and I have I try to be fairly unbiased about it. I'm not an overly big fan, but not because of cryptocurrencies themselves, just because I think the challenges that they're going to face moving forward. But one of the things we're seeing right now is more and more less than legitimate businesses out there trying to take advantage of the crypto craze, and more platforms, trade-in platforms. We talked to a few weeks ago about Coinbase out there buying up some of these small startups that really can't afford to be competitive. But there's also a lot that are less legitimate out there that be very careful of out there, and you might be getting yourself in trouble with a little bit. Walmart's one of the subsidiaries, one of the backed companies, Symbiotic, has partnered up with SoftBank. SoftBank's SPAC, or Special Purpose Acquisition Corporation. They're in talks about a $4.5 billion merger. And this is Walmart invested into a company that does robotics and automation, probably investing to have a foothold in this type of automation for their warehouses and deliveries. What they're talking with SoftBank, who runs these blank check SPACs, about combining and getting the firm valued at about a $4.5 billion deal. And again, just continuing on that IPO trend that we're seeing out there. Silver Lake is actually looking out to buy the New York Stock Exchange owner ICE's stake in Euroclear for about $709 million. So, as well as the IPOs, the M&A continues strong in these markets, and we expect that to keep going for the end of the year. And remember, there is new legislation being pushed in the United States. So, a lot of these mergers and acquisitions are being pushed through even quicker because they want to get in ahead of the new antitrust laws. So let's see what's new this week coming up in the markets. J&J, as I mentioned, are going to report their third earnings, setting the tone for that pharmaceutical company's earnings and also the sector, seeing how they did with their COVID-19 vaccine production. J&J, though, keep in mind, is a broad distributor of product. I've mentioned before, go through your soaps and your medicine cabinets and your anything to do around your household goods. Between them and Procter & Gamble, they probably take up more than 50% of your cupboards. And they're looking to put potential liabilities from lawsuits and things like that behind them after this quarter. Halliburton is expected to post a third straight quarter of profits off their crude oil prices. Obviously, we just talked about, big surge there. Oil's well above $80 now. I think around $83 today. And Netflix is expected to post a rise in revenue, strong subscriber additions, of course, off their South Korean series Squid Game, which is cost them $21 million to make that series, 9 episodes of that series. And it's estimated to be worth about $900 million for them alone so far. So the most popular series they've ever put out is that Squid Game. If you haven't watched it, it's for a different crew. Try watching episode 1 if you don't have the stomach or it's not your taste. I wouldn't recommend watching the rest. Also going on in the U.S., the job market continues to be tight. The fight for more pay continues. We've even seen, minimum wage actors group in Ontario who were fighting for, just a year ago, we're fighting for $15 an hour, now up in that to $18 an hour. And that's a lot around inflation. We've talked about inflation, this transitory inflation. The big challenge with this transitory inflation, the biggest areas it's affected is housing, food, and fuel. And really, you can't avoid those 3 things, right? If you can avoid those, well, you're living off the grid. Those are the 3 big categories that have been affected by this inflation. And while it might be transitory at this levels, it's not going back to where it was. So even if we see the inflation drop off a little bit, it's not going back down to 0 or 1% or even 2%. I think the target is to be between 2 and 3%. I think we're going to stay at the high end of 3, even when we get past this supply chain issue. So that $15 minimum wage, is just not going to be enough. And that's why we're seeing the shortage, especially in the service industries. People just can't survive on that. I've got two children in university, and I feel so bad for younger people who are starting out because, we were joking the other day, my first year university tuition was $1,100. Today, first year tuition, depending on what program of school, could be anywhere between $6,000 and $12,000 in Canada. And that's not included in room and board, right? So, or books or anything else. That's just your tuitions. So, kids today at $15 an hour to work their, full-time through the entire summer and save everything that they make really can't afford to go to school. And if you think about someone who's trying to, support themselves or even a family, that minimum wage of $15, I don't think it's going to survive. I think there's going to be some big changes there. And I think we're going to continue to see this staffing shortage continue until something happens on that front. Because what the pandemic did was when all these service and hospitality jobs were shut down and people were let go, they went and found other opportunities, other skill sets that are making them more than that minimum wage, and they're not coming back because why would they? They're making more money now. They have more growth opportunity, more potential to earn a viable living out there. So this is going to continue. Big battle. Obviously, it's going to be a much bigger battle in the U.S. because of their view the minimum wage. Some states down there, minimum wage is only a few dollars, and the rest, they have to survive on tips. Whereas, here in Canada, we were already pretty close to the $15 in some provinces over, but I think we're going to see that pushed even higher as things move along. We're also seeing 5 of the U.S. lawmakers accusing Amazon possibly lying to Congress. We just saw Facebook have a whistleblower, testify that Facebook was lying. Amazon's, this is a bit around their store potential. So if you're not familiar kind of with the Amazon structure, Amazon has their own products, the featured products, sometimes called Amazon Choice if you go into their apps or into the website. And that's sold directly by Amazon or manufactured by Amazon. But then other people have their stores there, and they're being accused of basically, if I were to go open a store on Amazon and sell a product and then become, very popular and sell, have really strong sales, Amazon will go and use that data, build their own version of that product, feature it above yours and put it at slightly cheaper price, and then, kind of basically stealing your business. So there's this back and forth, and that all goes to kind of the antitrust suits we're seeing around the world with the bigger tech companies. Apple just had on yesterday, they had a big live event, doubling down on the new chips. So if you followed the previous big product announcement, the new Apple 13, the new Watch 7, I think it is, all featured using the Apple chip. So they moved away from exterior chip manufacturers. They used to use ARM at one point, they used Intel at some point. Well, now they've moved their MacBooks into using their own chips. And they've launched a couple of new MacBooks, and I think they've got new AirPods coming out as well. New AirPods generation, I think they're on generation 4 now. So if you're interested in that, those have been pushed out. Of course, this is common for them to put out just before Christmas season. But if it's anything like the phone launch that we saw just a month ago, back to that chip manufacturing, they're having troubles getting out the volumes on time. So, if you're interested in upgrading some of these things, definitely order it earlier than later, especially if you're looking for to give it to someone for the holidays. Facebook's planning on hiring 10,000 in the EU to build a metaverse. So over the next 5 years, basically the social media giant wants to create this metaverse of an online world where people can use different devices to move and communicate in virtual environment. They kind of launched this a little while ago. They launched their virtual reality meetings. So just like this, Zoom, we could be meeting, only I could see, your little avatars out there, and you could see my avatar, and we could potentially interact in conversations through those. It was pretty rudimentary what they launched a few months ago, but they're looking to build that out and create something a little bit more, realistic. It kind of reminds me of one of the kids' books called Ready Player One, where people just live in these worlds. But we'll keep a close eye on it because it is interesting technology. And when you talk about the gaming world, it is kind of the way things are headed. On the foreign exchange front, the US dollar fell broadly. Of course, we had strengthened markets. That's not surprising. Bitcoin kind of had a new record. I think it was over 60,000 US. And it also started trading first US. So we've had Canadian exchange traded funds, but we see it on the US now under BITO, BITO. Well, they'll be watching that, so we're watching that for flows of the funds. Anytime these big ETFs come out, they have to go out and buy the cryptocurrency, then hold it right inside the fund. So it does drive the price up a bit with that artificial volume, or I guess real volume, but different volume. I always caution people with the ETFs, if you are investing in cryptocurrencies, caution using the ETFs. And the big reason is cryptos trade and the price moves dramatically on a 24/7 basis. So that means, at midnight, there could be a 40, and we have seen a 40% move on the price of some of these cryptos, or on the weekends. And if you're through an ETF, it's only trading during market hours, right? So 9 to 5 or 9 to 4 Eastern time. So, you could miss out on a big move that you just can't take advantage of, or you can't get out of. If you are trading it, be careful of using the exchanges for that reason alone. Inflation, I talked about it, continues to persist, and we're seeing, as we mentioned every week, I think some central bank is out there talking about their monetary policy, and the European Central Bank's going to have a meeting on the 23rd to try to give some clarity about how they're going to handle inflation. On the commodity front, as I mentioned, oil up, sitting around 83 US right now, continues to hold strong. We don't see that really slowing down. Russia's talking about increasing their supply, but like I said, there's so many taps turned off around the world right now. I don't see too much weakness, maybe a little bit of volatility, but I don't see too much weakness. And of course, that demand's only going to increase as more and more people start traveling over the next 12 months, because a massive user of oil is planes, much more than vehicles. So, we can talk about the switch to electric vehicles all we want, but the big users are industrial and planes. So until that really starts to change, we're not going to see that drop off. And on the metal front, continue to see strength there. A lot of that's driven on inflation. Materials and energy tend to always do well in an inflationary market. So let's take a look at the change in the world and what is the world has changed out there, and have you changed your portfolio, or what you should be looking at in changing your portfolio. So with that, this is Mike on Money. So what are we seeing out there? We've talked about the inflation change. We've seen the economic impact of the shutdown over the last year and the reopening again. The supply chain has happened. We've seen different countries print money, different stimulus. We're now turning the corner of that stimulus packages to look at the potential tightening or ending of these packages. And that means a lot when we're talking about macroeconomics, and a lot about how we want to position the portfolios. And we've covered off some different pieces out there. We've talked about value versus growth, different sectors like technology, versus financials. And then last week we talked about alternatives as well. So I want to bring it a bit kind of together when we're talking about these shifts in portfolios and what you have to look at. So the first thing you have to look at is your asset allocation, right? So your asset allocation is not just looking at the different, bonds versus stocks, but what do you have within those two categories, and geography as well. And when you build that, it's not kind of, it's not a kid's puzzle where you're putting together two big pieces. This is, the 1,000-piece puzzle. You've got to see how each one of those pieces are going to interact with each other, especially when we're looking at this type of environment, because it's not a bull environment. A bull environment, which we saw the later half of 2020, was, you could put any pieces down, everything was kind of moving up. Some were moving faster than others. 100% you could have done better if you, positioned in certain ways, but everything was going up. So, the puzzle was a lot easier. Now we're in a much more technical type of market, really understanding what pieces you have in there. And I'm going to start off talking about the fixed income side, because, a lot of people look for safety and yield. But we can't look the traditional or the standard view. Even if we go back 10 years, the 10 years fixed income returns of 2.7% are down 32.5% in yield from back in just 2016, and 57% compared to the yields we saw in 2011. So you can't rely on the bonds. They're more volatile than they've ever been, and the yields are really low. So when you're looking at your fixed income, you really have to replace that kind of traditional bond and some of your equity exposures as well, and really look at alternative strategies. So we talked about a bit about alternative strategies last week. If you don't use them in your portfolio, reach out to us. Happy to talk to you about how you can use them. I'm not talking about leveraged funds or leveraged hedge funds that bring in a ton of, commodity betting or risk. This is just using things like derivatives to offset those risks, offset and enhance your returns, especially when we talk about the yield side. So on fixed income, having some alternative strategies in your fixed income can really bolster your portfolio. You replace that core, broad spectrum bond portfolio or potentially ETF or fund that you're using, and really look for a portfolio that can use derivatives at kind of that long short credit. That doesn't mean more risk, right? They're only offsetting risk. They're limiting the downside with those derivatives or with the shorts, just to keep volatility lower, which is what you want from that fixed income portfolio. But it also enhances yield, right? They can play the arbitrage spreads on those, getting you an extra 1 or 2%, minimum kind of per year by using these strategies. And when you can't get the yield naturally, that makes a big impact on your portfolio, especially when you look at the credit side. And using the traditional long or the long credit exposures in your portfolio is doubly risky right now, because not only are you getting a really low yield, but on top of that, as bonds versus interest rates, you're in a teeter-totter kind of pattern. When interest rates go up, the value of your bonds go down. So Yes, if you buy in at a 10-year bond at 1.6%, 1.65%, if you hold for the 10 years, you will get that 1.65. But if you sell anytime before the 10 years, you might not get that 1. You can actually lose some money on that. So you kind of get double risky, and that's where that leverage or that short can come into play. Not only get you higher than that 1.65, but protects you when that interest rate move does happen. Protect you from that downside of things. So really look at those long shorts, and that applies to your equities as well. Now, I'm not saying all your equities should be long short or should be using derivatives, but there are ways to improve the quality of your returns. We've used in the portfolio for a couple of years now. We've used a covered call option as derivative option on our bank stocks, where it basically all it does, it enhances the dividend from about roughly 4 to 6%, so 2% extra, takes down volatility and very limited risk that you're adding into using that strategy. You might, if there's a big massive run up in the bank stock prices, you might limit your upside on it, right? And you might miss out on a couple percent of the upside. But that's bank stocks are so big, they don't generally, jump up $10 a share, in a couple of weeks. They tend to be fairly steady movers. So that covered call option just gives you that extra protection and that extra yield. Well, you can do that across your portfolio. You can do it across a broad index, so you can offset the risk of, say, the US market or the Canadian market or any global market, or currencies in your portfolio. If you have a big exposure, say, to the US, potentially the euro, you can use those long shorts or derivatives anyway to offset those. And on the equity side of things, you can take away some of the negative impact of a down market and enhance your returns on the upside. And that's just by using the long shorts, very specific on sectors, because generally when the markets are going down, as we've seen since the summertime here, we've seen more negativity in the tech or growth areas and more growth in the value. So if you were to take a conservative long short approach to growth versus value, you would reduce volatility in that portfolio, but increase the returns as well. So really taking a look at those alternatives should be part of the portfolios. Everyone's percentage there is going to be different depending on what the rest of those puzzle pieces are and how they fit together, and also what your goals are. Keep in mind, a lot of these alternatives do have different liquidities than normal. They might be only liquid once a week, some once a month. A lot of them are daily now. There's something called liquid alts that can give you daily liquidity. They're not bad. Just know why you're buying it. Do you need that daily liquidity? Because it does change a little bit how the portfolio operates depending on what liquidity approach you take. So again, know what you're buying, make sure it's right for you in that situation. Obviously a multi-approach. So, add this to an existing portfolio. None of the advice or none of the strategies we ever talk about here is an all-in type of approach. Be diversified. Really look at your fixed income, maximize that. Shouldn't be reducing your fixed income portfolio. We've seen that actually a little bit over the last year or two. Some people who their overall risk strategy, they might have been that traditional 60-40 split. It's not a strategy I would recommend. We've done a couple of videos on the 60-40. You can go look at those. But they've really reduced their 40 bonds down, say 10 or 15 or 20, because they're in search for growth. They're in search of yield that they're not getting on that side. But when you do that, you've now exposed your portfolio to a lot more risk as well. So if there were a correction in the market, if there was some sort of serious or longer term downturn on the equity side of things, you've given up that protection. And that impact might be worse than giving up some returns. But by adding some of the alts into your fixed income portfolio, giving yourself that protection, getting yield, right? Being very strategic, still getting that yield with low volatility, but not exposing yourself to that equity risk. You can still achieve the same thing in your portfolio. So be very conscious of, what's the appropriate asset allocation for your risk levels. So again, happy to talk to you about that. and make sure that you're in tune with kind of what your needs are and what your long-term needs are. Putting it all together, well, out there's a lot of different tools, to take a look at your strategic asset allocation decisions, what's changing on an ongoing basis. We are in this big state of flux. We've talked about the markets being fairly volatile, and will likely stay somewhat volatile for the rest of this year. Again, as I always say, that's an opportunity. Really pay attention to your bond or your fixed income side of your portfolios, because again, that's where a lot of people get into trouble when fixed income isn't performing. They will jump over to equities for that, that attractive return, but you take on volatility when you do that. So it's really, really important to know how much you might want to put a bit more in equities, but are there alternatives out there that can replicate or at least bridge the returns between bonds and equities without increasing a ton of risk, or without increasing any risk in your portfolio through that change. Definitely look at replacing those core bonds and credit exposures. There's a lot of alternatives. There's even, I've talked about them before, there's the inflation protected bonds that their interest rates that they pay basically move with inflation. So as inflation goes up, their payouts go up. So you're kind of protected in a rising interest rate market. Again, I wouldn't go in all in on those because you could have staggered inflation or stagflation. But for a portion of it, you can use those in your portfolios, and we certainly have them in ours as well. Really recommend, I can't stress this enough, take a total approach to your portfolio. One of the most dangerous questions I ever get from people is, what stock should I buy, or what thing should I buy? And it shouldn't be one thing, right? It should be, what things should you buy for your situation? What's the right mix? Because you don't want to be all equities. You don't want to be all the same equities. You don't want to be all the same geography. Anything. You want to make sure that you've got offsetting correlations in that portfolio, so you're maximizing returns throughout a volatile market, but you're also minimizing your personal volatility. The market can be volatile, but as long as your portfolio is minimizing its volatility, you've built a really good portfolio. So pay attention to the construction side. Know what you're putting in, have that balance. And, that goes to the beginning of 2021, even when we start talking about value over growth being the more favored area for this year, which we've certainly seen value outperform. But it doesn't mean you get completely out of growth. There are still some names, there are still some sectors that are performing well in there, and they should be in your portfolio. So with that, as always, go to mikeonmoney.com with any of your questions, suggestions. You subscribe to our YouTube channel. This will be up on YouTube probably by tomorrow morning. And of course, our podcast, you can go listen to us there. Always love hearing from you. Any ideas about topics that you'd like to hear about, or again, this portfolio construction thing, especially in this type of market, takes a bit more. It takes a bit more work on to get it right, get it created specifically for your situation. By all means, reach out to us. We're happy to talk to you and help you any way we can. So with that, thank you, everyone. Take care and enjoy your day.